Background: The business of exchanges. Part 2. What is an exchange and the instruments? What is an exchange? At its most basic level, an exchange is a marketplace where securities, stocks, bonds, options, futures, and other financial instruments, more on that in a bit, are bought and sold. But unlike the farmer's market, where you can see the vegetables and haggle with the seller, exchange deals in ownership rights that exist primarily as electronic records where you constantly have buyers and sellers exchanging at a price. For example, when you see a stock price displayed on a screen, say Apple, AAPL, at $212.53, what you're actually seeing at that price at which the last recorded public transaction transpired. This last price is simply a record what someone was willing to pay and someone else was willing to accept for a share of Apple at a specific moment in time. The other price you may see are bid and asks. The bid is the highest price a buyer is currently willing to pay for a share, and the ask, or sometimes called the offer, is the lowest price a seller is currently willing to accept. The difference between these two is called the spread. The spread might be just a penny for a highly liquid stock, which is one that has a large number of transactions in a short time. Stocks, for example, like Apple. It could be substantial for thin traded stocks that change hands rarely. This exchange maintain an order book that lists all bids and asks, creating a marketplace where buyers and sellers meet. Major exchanges around the world. The world's stock exchanges vary enormously by size, with the largest dwarfing the smallest. The New York Stock Exchange, NYSE, the world's largest exchange by market capitalization, hosts over 2,300 companies and it's valued at $25 trillion. Nasdaq, a close second, home to many technology giants such as Apple, Microsoft, and Amazon. The Tokyo Stock Exchange, the largest in Asia, with 3,700 companies. Shanghai Stock Exchange, Euronext, which has operating markets in Amsterdam, Brussels, Dublin, Lisbon, Oslo, Milan, and Paris. London Stock Exchange, Hong Kong Stock Exchange, and in Canada here, Toronto Stock Exchange. Again, more later. There are many others across the globe. Some exchanges focus on commodities, some on bonds, and some are full-fledged ecosystems. Types of exchanges. Exchanges have evolved dramatically over the centuries, but we can broadly categorize them in two different groups. Floor-based exchanges, the farmers' markets of stocks. When you think of a stock market with trading running, yelling, and flashing lights as depicted in movies, you're thinking of floor-based exchanges. Floor-based exchanges operate on a similar principle as a farmer's market. Picture traders in their colorful jackets, shouting and waving their arms to buy and sell stocks, like farmers bargaining over the price of corn or apples. On a traditional trading floor, designated market makers, formerly called specialists, are assigned specific stocks, and their parallel in a farmer's market would be an owner of each stall. Floor brokers execute trades on behalf of their clients. On a farmer's market, this would be the customers passing the stalls. And then it has open outcry. This word might seem unfamiliar, but it's just the hand signals and verbal bids that are used on the trading floor. The image of traders in colorful jackets running, shouting, yelling from one edge of the room to the other is mainly historical at this point. Even the New York Stock Exchange, the most famous example of floor-based exchange, is not primarily a televised studio with some minimal trading functions rather than the chaotic scene depicted in movies. The main reason is simply more efficient, accurate, reliable, faster, and less chaotic to let computers execute the trades. Moreover, as volumes rose, amounts of trades happening, and technology improved, floor traders became obsolete. The other type, electronic exchanges, the Amazon.com of trading. As floor-based exchanges became obsolete, computers and algorithms took over their main functions. These exchanges are called electronic exchanges. Think of them like an Amazon.com of the exchange world. Every function is done faster, and you can snap your fingers. Most modern exchanges are fully electronics, including the Nasdaq, which has never had a trading floor, the Euronext, which is the European one, and it is fully electronic. And most modern stock exchanges, especially those built in recent years, are fully electronics. In electronic exchanges, computer systems match buyers and sellers automatically. This fact means, unlike on floor-based exchanges where traders could take minutes, they occur in milliseconds. Moreover, you don't need to rely on conducting a trader to place an order. You just need a screen. The shift to electronic trading has dramatically increased the speed and volume of transactions while reducing costs. The New York Stock Exchange might execute over 3 billion shares on a typical day, a volume that would have been unimaginable in an era of purely manual trading. That said, I'll tip my hat to the old days. There's something special about the human touch, the energy of the trading floor in full swing, and watching the records of the chaos on the floor, as it just makes it feel a lot more real. But when you're handling today's markets, you need something that can keep up. It's like choosing between a horse-drawn carriage and a Ferrari. Both will get you there, but one's a lot quicker and doesn't need a barn. Beyond the mechanics. While the technical operation of exchanges is fascinating, it's important to remember their fundamental economic role. Exchanges provide price discovery, helping determine what assets are truly worth, liquidity, making it possible to convert investments to cash quickly, capital formation, allowing companies to raise money from the public, wealth creation and distribution, enabling ordinary people to own a piece of successful businesses. When you see a stock price crash across your screen, remember, behind that simple number is an intricate system bringing together buyers and sellers from all over the world. This system has evolved over centuries, yet it still serves its core purpose, creating a fair, efficient marketplace where capital can flow to its most productive uses. One key feature that distinguishes exchanges from other trading platforms is the central book, and this is why it matters. What is a central book? The central book, often called the central limit order book, is a centralized system that records all buys and sell orders on a specific security like a stock. Picture it a giant, real-time list, diary, or more accurately, a ledger. Every bid to buy and every offer to sell is logged, and orders are matched based on two principles, price and time. The highest bid and the lowest ask are collected, see above for definitions, and get priority. If two orders have the same price, the one placed first goes through. This setup ensures that the exchanges are transparent. Everybody can see the exact same information, and fair, that no one can jump the queue unfairly. Why do central books set exchanges apart? Unlike other trading platforms, say the over-the-counter market, more on this later, where traders can happen privately between parties can agree on a price for a transaction, stocks exchanges trade with a central book offer a single unified marketplace, meaning the exact same screen for everyone. The difference brings some big advantages. Better liquidity. With all buyers and sellers in one place, it's easier to find a match, reducing drastic price swings. Fairer prices. Everybody sees the same bid and offers, so there's no room for hidden deals or price discrepancies. More efficiency. Thanks to the organized system, traders are executed quickly at the best available price. Centralized book approach is a huge reason why stock exchanges have been the backbone of global trading for centuries. They're fine-tuned to the art of transforming the chaos of buying and selling into an orderly, reliable process. The following section will explore how exchanges generate revenue, how they're regulated, and why they might make interesting investments in opportunities themselves. Types of instruments. Now, I'm sure many of you are familiar with a variety of instruments you may encounter in a marketplace, but let's humor me for a moment and try to apply these instruments to a real-life example. For the purpose of this explanation, let's say we're taking over an old bookstore called Old Book Inc. I know, a very original name, from a family friend. We bought their business and got 100% ownership. What did we buy? We purchased a small store that sells stationery items such as paper, pens, ink, pencils, cards, and books. Now we want to we are the proud owners of Old Books Inc. and have ambitions to build an online retailer to rival Amazon. We have a vision and how we can help develop the business, but we realize we need capital to make it back reality. How can we ever raise the necessary capital? Equity. Option 1. Sell a piece of your business. One way we can raise the necessary capital is to sell a piece of your business. You see this on shows like Shark Tank, where business owners offer a price for their business for cash. For example, we are asking for $100,000 for 25% of your business. This process is the selling of equity in your company. Equity comes from the Latin word equitas, meaning fairness or equality. In finance, it represents a fair claim to ownership. There are a few different ways in which you can sell equity. Common stock. This is the most fundamental form of ownership. If you sold common stock in Old Book Inc., buyers would become partial owners with voting rights on a major decision like electing the board of directors. If the bookstore chain became profitable, These shareholders might receive dividends, a portion of the profits. If Old Book Inc. eventually gets acquired by, for example, Barnes & Nobles or Chapters in Canada, for twice its current value, common shareholders would see their investments double. Preferred stock. Some investors may want more certainty than common stock offers. You could issue preferred stocks that promise a fixed 5% annual dividend, paid before any dividends go to common stockholders. These investors might be sacrificing their voting rights. Still, they get first dibs on any profit distributions and, in case of bankruptcy, would be ahead of common shareholders in any sale of distributions. Warrants. Some investors may be hesitant to invest in your business right now. However, they like your ambition and would like the option to invest in your business in the future. They can pay you a fee, and you would issue warrants that give the investor the right to buy additional shares at today's price any time in the next 5 years. If Old Books turns around, share prices triple, those warrants become very valuable. Rights. If you need a quick capital injections, putting cash into the business, you could issue rights to existing shareholders, allowing them to buy additional shares at a 15% discount, rewarding them for their loyalty while raising needed funds. 2. Bonds. Fixing them. Option 2. Get a loan. What if you don't want to sell a piece of your business? Well, you could always get a loan. You gather your business plans, projects, and bank information and head to your bank. You sit down with the representative and share your grandiose plans. The representative seems really into it. They give you a big smile, offer you a coffee, and tell you they got your back. They head upstairs and hash out the final details with their manager. You sit there, proud and happy, your vision itching closer to reality. The representative comes back and says, "Done deal! We're so excited to help you out. Just sign here." You read over the terms, and the bank offers you a loan with an interest rate of 25% over 5 years. You're shocked. You can't accept this deal. It's simply too much. If you borrow $100,000, you'll end up paying $225,540. By the end of the loan, dejected, you leave the bank and start thinking of a new plan. You had a solid reputation in your neighborhood. Along with friends and family, you decide to get a loan from the public. This is a bond. The term bond comes from the Old English word band, referring to something that binds or connects, in this case, connecting the borrower to a lender through a financial obligation. There are a few different types of bonds. Corporate bonds. Old Book Inc. could raise $1 million in bonds with a 6% yield with a 10-year maturity. Your rich uncle lends you $100,000, receiving $6,000 in interest payments annually, with his principal, the $100,000, returned as a lump sum after 10 years. Like equity investors, bondholders don't own part of the business. They're lenders with a fixed claim to interest and principal. Convertible bonds. Maybe nobody wants to lend you at a low interest rate, as they think you're too risky. To make your bonds more attractive, you might make them convertible, giving the bondholder the option to convert the bond into a predetermined number of shares, stock, instead of receiving the principal back. If Old Book Inc. thrives and stock soars, bondholders could choose to become owners instead of remaining lenders, converting the loan into ownership. Zero coupon bonds. Perhaps you don't want to pay interest yearly because you think you will have more cash later. You might issue zero coupon bonds that pay no annual interest. Instead, investors buy at a discount, giving you $600,000 per bonds today with a $1 million face value, money you would have to return your investors once the loan expires, with the difference between the two values representing the interest earned. Derivatives. You've secured your capital and are busy building your business. Inside your bookstore, you add a cozy lounge, serving warm drinks and baked goods to delight your customers. But as time rolls on, your business expands and you notice something tricky. The price of goods you rely on, books, paper, flour, coffee, keep bouncing up and down throughout the year. It's a headache trying to charge customers consistent prices while your cost won't stay put. You start wondering if there's a way to lock in your prices you pay to wholesalers for books and paper, or even the flour and coffee you need. Heck, you'll even pay for that certainty, just so you know your cost ahead of time. All you want is stability. Then your friend pipes up an idea. Derivatives. You hesitate, remembering Warren Buffett's stern warning. I view derivatives as a time bomb, both for parties that deal in them and the economic system. Still, your friend's enthusiasm nudges you to take a closer look. The word derivative means something drawn from another source. These financial tools get their value from underlying assets. Here are some derivatives you might consider for your business. Options. Imagine buying insurance that gives you the option but doesn't force you to buy or sell something at X price at a later date. That's an option. Say you're worried about a new book by a highly anticipated author's novel flopping, but you don't want to miss out on a potential profit if it's the next Harry Potter. You pay the distributor a small fee for the right to buy copies at $10 each in the future without buying any right now. If the book takes off and the price soars, you cash it, securing them at $10 and selling at a profit. If it's a dud, you walk away with no obligation to buy them. Contracts like these give you the right but not the obligation to buy, that's a call, or sell, that's a put, an asset at the set price before or at expiration. Futures. Similar to options, futures are agreements to buy or sell something at a price locked in today. But here's the catch. You're committed. For example, you want to keep selling coffee at $5 a cup in your lounge, no matter what. But you buy a future contract to get coffee beans at $2 per pound in 6 months. If bean prices drop to $1, you'll pay $2 and miss out on extra profit. But if you shoot up to $4, you're still paying $2, keeping your $5 price steady. It's a trade-off for certainty. Forwards. Consider these futures private cousins, customized deals not traded on public exchanges. You sit down directly with another business, say a local coffee roaster, and agree to buy beans at $2 per pound next year. It's tailored to your needs, but there's no exchange to back it up. Just trust between you and them. Similar to futures, but quieter and more personal. Swaps. Just like swapping unpredictability for calm between contracts. Suppose your supplier gives you a rolling credit that is prime government risk-free rate plus 2%. Another shop in town has a fixed loan at a rate of 5%. You decide you would rather know your expenses than have the interest rate risk, so you pay the fee to swap contracts. The other store takes the risk of interest rates jumping, and you get a peace of mind. Though this is a bit fancy for a small shop, it usually happens off exchanges. Contracts for differences, CFDs. These are a lot like bets on a price moves without owning anything. Say you think flour prices will rise next month. You agree with the broker to packet the difference between today's price of $10 per bag and whatever hits later, maybe $12, without buying the flour. If you're right, you profit. If not, you pay. It's a gamble, not as stable for running your lounge, but it's out there. Exchange-traded funds, ETFs, mutual funds, and indexes. You've mastered the financial tricks, loans, bonds, derivatives, and poured the know-how into your bookstore and lounge. Hard work pays off. Your business blossoms into a regional champion with multiple locations and one step closer to taking down Amazon. As growth kicks in, you take a deep leap and launch an initial public offering, IPO. Meaning your shares now trade on the exchange. Congrats! Something neat happens next. These shares start changing hands like hotcakes. People notice, buzz builds, and your business's valuation climbs right along with it. Suddenly, you're on the radar of mutual fund managers, your stock getting roped into indices, and even lands in an ETF. But what are these things? Why do they matter to you? Let's break them down. First, mutual funds. These are pools of money for many investors. These pools are later managed by professional money managers and their teams. The teams get paid for their services from the pool. Some of these managers might scoop up your shares. There are two flavors. Open-end funds, where investors buy or sell shares directly from the fund company, not on the exchanges, like ordering straight from the factory, and buy-sell on valuations of what is in the basket. But then there is closed-end funds, which trade on exchanges like regular stocks, sometimes at a bargain or premium to the real value of their baskets. The mutual fund likes your bookstore story, steady coffee sales, loyal book buyers. They might grab your stock in their fund, giving you a cash boost or bargaining rights. Next, indices. Think of these as scoreboards tracking a bunch of stocks, like the Dow Jones or S&P 500. They don't trade on their own, but they're the backbone of the other tools. As your business grows, they might add you to an index, say for retail or small cap champs. That's a badge of honor. It means you're a player. Plus, it ties into derivatives like those index options or futures we talked about, and ETFs. More on them in a second, pulling more eyes your way. And then there's exchange-traded funds, ETFs. Picture a basket of goodies, stocks, bonds, whatever. But you buy one share and get a tiny slice of everything that's inside of that basket instead of buying each single thing in the basket separately. Your stocks might end up in one as you grow. Here's what's out there. Equity ETFs track stocks indexes like S&P 500. Maybe your shares join the party. Bond ETFs, full of fixed income stuff, less your speed. Commodity ETFs, chase gold or oil prices, though coffee bean ETFs aren't a big yet. Sector ETFs, zoom in on industries. Imagine a bookstore and cafe sector with you in it. And inverse leverage ETFs. They're wild, bidding against or juicing up an index's move. Not your usual cup of tea. Real estate investment trusts, REITs. You have come a long way. Your bookstore and lounge empire is now a powerhouse, growing steadily and flush with cash. You're itching to grow to rival the big chains around the country, but there are only so many shops you can open before you hit a wall. So you sit down to scout new opportunities. You start studying other successful chains, and one giant catches your eye. Howard Schultz, Starbucks. Digging into their business, you stumble across the Starbucks effect. Neighborhood properties prices jump when Starbucks pops up. Curious, you check your own locations. What do you know? Your shop sparked the same magic. Dollar signs flashing your mind. You could snap up the real estate around your stores and ride the wave, but you don't want to tie up all your precious cash you've earned. So you hatch a plan. You pool some of your money with your investors and launch a REIT, a real estate investment trust. Think of a REIT as a stock-like investment that owns properties or property-related assets. Here's what they look like. Equity REITs. These own and run income-producing real estate. Think of them strip malls, buildings near your shop, rented out space for steady income cash inflow. Mortgage REITs. These focus on lending, investing in mortgages or mortgage-backed securities, earning interest rather than rent. Hybrid REITs, a mix of both, owning property and holding on mortgages, blending the best of both worlds. As your bookstore and lounge empire grows, you might stumble across each of the other financial tools. Fancy stuff I won't linger on too much, like commodities, trading gold, oil, and even coffee beans outright, usually through those futures we talked about, or tracking baskets of them via indices. Then there's Forex, swapping currencies fast and spot traders, or betting on exchange rates with currency futures and options. Handy if your coffee supplier is overseas. And don't forget structured products, things like asset-backed securities, bonds tied to loans, collateralized debt obligations, fancy loan bundles, or equity-linked notes, debt hitched to stock performance. They're out there, mostly off exchanges, and you might come across your path as you scale up, so don't trip over them.